Hi, my name is George Dagnino. I'm the editor of the Peter Dag portfolio. You can find my work on www.peterdag.com or peterdag.blogspot.com. This presentation was made in November 2011 in the midst of European crisis. I have been very negative on Europe for many years. And the purpose of this presentation is to give you the real reason why Europe has problems and will always have problems. In order to understand what is happening in Europe, one has to understand the idea of productivity. And the best way to explain it is, if you think you are a shoemaker and you make one shoe per day and you sell it for $50, and let's say you invest in some machine and instead of making one shoe per day, this machine allows you to make 2 shoes per day. Now your income rises to $100 per day. So really, by increasing your productivity, in fact by doubling your productivity, your income has doubled from $50 to $100. So the important thing here, the concept is that by improving your productivity, you also improve your income. And when you add all the populations together, by increasing the productivity of the country, you increase the income and the purchasing power of the country, that is, its wealth. And this is what I've said in the previous slide. Rising productivity translates into rising income and to higher purchasing power for the country. And the bottom line is productivity is the most important parameter for any country. And I'll show you why. The country with the highest productivity has a competitive advantage relative to the other countries. Why? Because people buy from the most efficient countries. These countries are likely to produce the products that we want with the quality that we want for the price that we want. So the highest productivity countries have a definite competitive advantage relative to the less efficient ones. The most successful country is therefore the country that has most competitive industries, because the world will buy the most from them, and therefore that is what makes that country wealthy. How do you know that that country has a lot of industries that are competitive in the world market? They are the most competitive in the world market. Well, is the country that has a strong currency. Why is that? The reason is very simple. Let's take it from the view of an American buyer who wants to buy a German car. What does the American buyer has to do? Well, they have to sell dollars, okay, to buy euros, because the Germans want euros. They don't want dollars. So by selling dollars, they make the dollar weak. By buying euros, when you buy something, the prices, if everybody that buys euros, the euros get stronger. You give the money to the German car manufacturers to buy the car. The outcome, what is the outcome? The outcome is that the dollar weakens and the euro strengthens. So you can see why the more competitive industries Germany has, the more the currency, the German currency, which in a way is the euro, gets stronger. The reason for the European crisis is that countries like Greece, Italy, Spain, or Portugal cannot compete against Germany, because Germany has more competitive industries than they do. And so these countries, Greece and Portugal and Spain, have to borrow in order to survive. The main reason for the European gridlock, for the inefficiencies of countries like Greece, Italy, Spain, Portugal, is that the power structure is concentrated in very few hands. Large capital, banks, government are very closely related. The unions protect workers' rights. They are very, very strong, and if they want, they stop the country. And then there are the guilds, that they protect the various sectors of the economy, making very difficult to start new businesses and to find jobs. Of course, what would be the alternative to what is happening right now? Of course, if Greece had its own currency and central bank, what they would do, they would print money to pay off the debt, and of course they devalue the currency and live their own private dream by basking in inflation. Of course, their interest rates would be probably close to 6, 7, 8%. The reason Greece wanted to be part, like Italy and like Hungary and all these countries want to be part of Europe. Why? Because so they can borrow at the rate that Germany is borrowing. And it's not working because they are not producing the wealth to pay the interest on their debt. And above all, to compete against Germany. The same developments that you see in Europe, you can see it in the United States as well. Of course, in a much minor scale for a host of reasons. But when people go from Ohio or New Mexico and they go to New York or Connecticut, they find life much more expensive in those states. Why? Because those states have a much higher GDP per capita. And the reason they find life more expensive is because the New York, Connecticut, Delaware, and so on produce much more wealth per person than Ohio, and therefore, since there is more wealth, the standard of living is much higher. The lesson we can learn from Europe, and in a minor scale from the United States, is that purchasing power depends on competitiveness, depends on the number of industries in that country that are competitive on a global scale. And the second lesson is that the markets always win. The markets always will reward the countries which are highly competitive and punish the countries that are less competitive, like Italy, Spain, or Greece. The other lesson that we learn by looking at the European countries is that countries can borrow as much as they want in order to give outlandish benefits to their citizens, to various power groups. However, if the country does not produce the wealth to pay for the interest on the loan, the market eventually will catch up with those countries and will punish them. And this is what has been happening in Greece, in Portugal, in Spain, Italy, and Ireland. These countries promised a lot to their citizens, and the politicians gave all these benefits to the citizens without realizing that they had to borrow money, and at some point, if the country did not produce the wealth to pay the interest on the loans, the country would go under. And this is exactly what is happening in Europe. There is no doubt that these are very uncertain and very unique times. However, no matter how uncertain the times are, investor needs a framework, a strategic framework. I strongly believe that the business cycle is an anchor to develop investment strategy. You will find more information about this on YouTube, or if you go to my website, www.peterdag.com. Thank you for listening. I really appreciate it.